Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. And here we are, January 2nd, 2023, 10 p.m. on a Monday night. And remember what happened the last time a couple of crypto CEOs decided to have a slap fight in front of God and everybody? That's right. That was CZ, that was FTX, and that was SBF. And it ended up with FTX dead in the street. Now, one wonders if the same thing is about to happen again, because Cameron Winklevoss, co-founder of Gemini, accused Barry Silbert, CEO of Digital Currency Group, of stalling in paying back over $900 million owed to Gemini-earned customers. Silbert denies the accusations. Genesis is a crypto broker owned by Digital Currency Group. They stopped customers from withdrawing their money in November. The company owes about $900 million to users of Gemini Earn, which is what led to one of the founders of Gemini accusing the CEO of Digital Currency Group of not paying money back in good faith. Winklevoss tweeted an open letter to Barry Silbert on Monday. In that letter, Winklevoss accuses Silbert and DCG of avoiding the issue. He wrote that Gemini has attempted to find a mutually agreed-upon solution for returning funds to users in the dispute with DCG and Genesis. He said that he understands that there are costs associated with restructuring, and that things may not always move quickly. However, he also accused Silbert of not acting in good faith and intentionally delaying the process. He said Silbert has refused to meet with the leadership of Gemini to discuss the situation. He said they've refused to set a timeline for resolving it. He wrote that Silbert's behavior is not acceptable and is wrong. He also said that Silbert's belief that he can wait for the problem to disappear or that it's somebody else's responsibility is also not realistic. He continued, saying that DCG owes Genesis about $1.675 billion. This includes a $575 million loan due in May and a $1.1 billion promissory note due in June of 2032. Now that's related to the Three Arrows capital mess. Winklevoss said that these figures were shared by Silbert with investors in November. Now, Silbert is having none of this. He tweeted a response to these accusations. In his tweet, Silbert denied the accusations. He said that DCG recently made a proposal to both Gemini and Genesis. Further, Silbert tweeted that the company did not borrow that $1.675 billion and that it has never missed a payment to Genesis. He also said the company is current on all loans and that the next loan due is in May of 2023. He said that DCG made a proposal to Genesis and Gemini's advisors on December 29th, but has not yet received a response. Winklevoss has asked Silbert to publicly commit to resolving the issue by January 8th. He said, quote, "Will you or will you not commit to solving this by January 8th in a manner that treats the $1.1 billion promissory note as $1.1 billion? Gemini Earn is a service that lets customers earn high returns on their cryptocurrency deposits. But we're not talking about crazy high amounts like 20 or 30%. The amount of the return depends on the type of the asset held. Genesis was the main lending platform for Gemini. In November, Genesis stopped allowing customers to take out loans, and Gemini also stopped Earn users from withdrawing their money. Winklevoss said that Genesis owes more than $900 million to customers of Gemini Earn. This is the same amount that was reported by the Financial Times in early December. Last week, customers of Gemini filed a lawsuit against the company. They claim that the interest-bearing products offered by Earn should have been registered as securities. In a letter in November, Silbert tried to reassure investors that the company was not in immediate danger despite problems in the industry caused by the failure of FTX. However, it has been suggested that DCG is experiencing liquidity issues based on information from a creditor committee working on issues with Gemini and from a Dutch cryptocurrency exchange, Bitvavo. And speaking of CEOs behaving badly, Sam Bankman-Fried's company, Alameda Research, had problems before the creation of FTX. Now, it was previously thought that FTX and Alameda operated independently. However, a lawsuit has recently shown that the two companies have been working together since the very beginning. In fact, it looks like Alameda almost went under back in 2018, before there even was such a thing as FTX. Now, a report from Wall Street Journal stated that Alameda suffered significant losses due to its trading algorithm. This algorithm was meant to make many trades automatically, but the company lost money by incorrectly predicting price point changes. And so, in 2018, Alameda almost went bankrupt due to the decline in the value of XRP. This caused the company to lose almost 2/3 of its assets. However, Sam was able to save the trading firm by obtaining funding from lenders and investors who were promised returns of up to 20% on their investment. According to the report, in January of 2019, Alameda sponsored the first Binance Blockchain Week conference, and Sam used the opportunity to contact investors to obtain funding for his struggling firm. In April of 2019, FTX was launched with the goal of providing a secure place for institutional investors. After the launch of FTX, SBF used Alameda to support its growth. What happened is the trading company became the main market maker for the exchange. Now, it was always available for other traders to buy from and to sell to. Some people familiar with Alameda's methods claim that the exchange sometimes took the losing side of a deal to attract clients. Now, Sam has always previously said that Alameda and FTX operated separately. That said, a recent lawsuit by the Securities Exchange Commission suggests otherwise. The lawsuit showed that Sam instructed someone to create a piece of code to give Alameda an unfair advantage. This code allowed Alameda to maintain a negative balance on FTX without regard to the collateral that it provided. Sam also made sure that Alameda's FTX collateral would never be liquidated, even if its value fell below a certain point. This report did show that Alameda was in trouble from the beginning. However, not only did Sam rescue it in 2018 with borrowed money, he later used it to establish the now failed FTX cryptocurrency exchange and support its growth. Now, if Alameda had just died on the vine, like so many other failed companies have done, it would be interesting to see where we are today. In the United States, a new Congress will be sworn in, and a lot of predictions have been made about this thing or that regarding what Congress will and won't pass. Now, I'm not here to do any of that. I do know that some members of the U.S. Congress are discussing the possibility of banning stock trading. Now, all members of Congress must already report their investments in stocks and cryptocurrency, but there have been concerns about potential conflicts of interest. Some members from both political parties have expressed support for a law that would prevent members from investing in stocks or crypto. This issue may be addressed in the next session of Congress, which will have new leadership. The next session will start at noon tomorrow. Republicans will have a small majority in the House of Representatives, while Democrats will have a majority in the Senate. A Republican representative, Kevin McCarthy, may be the one who becomes the Speaker of the House. Now, he has said that he would consider a ban on lawmakers owning or trading stocks, including crypto, if his party gets control of the House. It's not known if McCarthy has enough support to become the leader of the House. In fact, for the first time in exactly 100 years, it may take more than one round of voting to determine who will preside over the House. The process for choosing the new leader will begin on January 3rd. Some have said that it's a conflict of interest for politicians to own and trade certain assets while they're in office. And even with those moderate rules in place, during the 117th session of Congress, 77 lawmakers reportedly broke the rules for disclosing their investments under the Stock Act. This included reporting allowable trades late. However, these members were still allowed to work on legislation that could be affected by their own investments. Senator Cynthia Ludmus, who is very pro-crypto and sits on the Senate Ag Committee, has reported investments in Bitcoin. There were controversies in 2022 about financial connections between U.S. lawmakers and industry leaders in the cryptocurrency space. I think we know who we're all talking about. Executives at FTX, including Sam Bankman-Fried, made donations to politicians and campaigns for both political parties. This has raised concerns about whether lawmakers could be objective in hearings about the company's failure. Zoe Lofgren is the chair of the Committee on House Administration. In September, she proposed a plan that would put limits on the members of Congress and the Supreme Court, as well as their families. This bill would stop them from owning or trading stocks, securities, commodities, futures, cryptocurrencies, and similar investments. This plan was not implemented in 2022, but the Federal Open Market Committee approved a similar rule that prevents senior officials at the Federal Reserve from owning or trading crypto. And now let's go from the US and take a look at Turkey, because they're going to use a digital identity application that's based on blockchain technology for online public services. This announcement came shortly after Turkey's central bank finished its first tests of a central bank digital currency. So, bleh. Now, Turkey is going to use blockchain technology for the login process for online public services. The Turkish government will use a digital identity system based on blockchain technology to verify citizens when they log into e-Devlet. Now, that's their digital portal that provides access to various public services. The vice president of Turkey is Fuat Aktay, and he announced that citizens will be able to use a digital identity based on blockchain technology to access e-wallet applications. This announcement was made at the Digital Turkey 2023 event. Aktay referred to the blockchain-based application as a revolution for e-government efforts. He also stated that online services will be more secure and accessible with the use of blockchain technology. Users will be able to store their digital information on their mobile phones. The president said that the login system for the e-wallet application will use a digital identity that's created on the blockchain network. And that's what's going to allow citizens to log into e-Devlet. Turkey has announced several blockchain projects in the past, but very few have been actually completed. The country has had plans for a national blockchain infrastructure since 2019. However, so far only a few proof-of-concept projects and a central bank digital currency test have been successful. The rest of Turkey's blockchain plans have not produced any results. For example, in January of 2020, the city of Konya in Turkey announced plans to develop a city coin project, and this would develop a city coin that citizens could use to pay for public services. However, no new information about this project has been made available for the public in the last 2 years. And from Turkey, let's go to Italy, because they have some important news for investors. The Italian government has passed a law that will impose a 26% tax on profits made from crypto trading. This new tax will be implemented as part of the budget for 2023. So Italy's Senate approved that budget, and that budget has a 26% tax on profits made from crypto trading. This tax will apply to trades that are worth more than 2,000 euros each, and it will go into effect on December 29th of 2022. The law defines crypto as digital assets that can be transferred and stored electronically using distributed ledger technology. Previously, cryptocurrencies were treated as foreign currencies in Italy and were taxed at a lower rate. This new legislation also allows taxpayers to declare the value of their digital assets on January 1 and pay a 14% tax on them. This lower amount is intended to encourage people in Italy to report their digital assets earlier rather than later. The new budget law also includes several other changes. There will be tax amnesties to reduce penalties for missed tax payments, tax breaks for businesses and households affected by the energy crisis, and incentives to create jobs. The retirement age will also be lowered. Giorgia Meloni is Italy's prime minister, and she has received a lot of support for her bill from the legislative body. This was even after she promised to make significant tax cuts when she was elected last September. Just to give you an idea what the local economic conditions are like, Italy's government has implemented measures to reduce gas consumption throughout the country. This includes shutting off the central heating for all buildings for over 15 days, as well as asking people to turn their heating down by 1 degree and to turn it off for 1 extra hour per day during the winter. Italy's legislation on cryptocurrency comes after the European Union approved the Markets in Crypto Assets Bill on October 10th. The MiCA bill creates a consistent regulatory framework for cryptocurrency in the EU's 27 member countries. It's expected to go into effect in 2024. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.